Good morning, Scott Van Pelt with Van Pelt and Associates. Thank you for blocking some time out of your busy schedules for this call. I am glad to see a lot of you return on the calls that we have on a regular basis. We hold these educational calls throughout the year on different topics pertaining to your planning and such. Today, we're having Tom Wilson from Brinker Capital to kind of cover the market and economic updates with us. I wanted to introduce our team, Karen Poor, Ellen Donahue, Blair Fetzer, Andrew Dans, Tracy Volpe, Lacey Hopper, and Nick Chukas is our IT support today. Our team is here to be a resource for your success. We have two locations to provide better service and or provide the service to service your needs. And we look forward to continuing to work with you. A couple of housekeeping items. All lines are going to be muted. This call is being recorded and will be available here in the next week or so on our website to play back. Since we are recording the session, we'll hold all the questions till the end of the call. I'm sure you're going to have questions come up throughout the call. You can use the chat feature to let us know, and we'll answer those questions towards the end. And then you can also raise your hand on the Zoom feature at the end, and then we can unmute your line to ask your question if you prefer that way. We are pleased to have Tom Wilson with Brinker Capital with us today. He's the Executive Financial President, Head of Wealth Management for Brinker. He's been in the industry for 30 years, directing the implementation of the firm's multi-asset class investment philosophy and disciplined in institutional and high net worth portfolios. He's been with Brinker, started out with Brinker. He's been with Davidson Capital, and then has come back to Brinker. He's got a wealth of knowledge on that front, and then he's also been frequently on investment and asset allocation commentator for CNBC, the Wall Street Journal, Associated Press, Bloomberg, Fox News, Foundation Endowment Money Management, along with some other ones. So Tom, appreciate you being here, and I'll turn it over to you and start your presentation. So the floor is yours.
All right. Well, Scott, thank you very much. It's a pleasure to be here. I was in the green room. I was testing out the microphone. So the microphone I'm using right now is a bit, I'd say, a little sensitive. So if it's scratchy, Scott, just speak up. I have a backup microphone that I can switch to in 5 seconds. So okay. Is this coming through okay right now?
You sound good. Yes.
All right. All right. Well, we'll think good thoughts, and we won't need Nick in your IT unit to help me out later. So, hey, again, thanks for everybody, joining us here, today. Before I get into the presentation, I was just going to spend 2-3 minutes, a little bit on Brinker Capital, for those of you who maybe are not as familiar, and then we're going to get into the presentation this afternoon. And I encourage you, as Scott just noted, to ask questions as we go along on the chat feature. We'll be more than happy to try to address those at the end of the presentation. And of course, Scott, I encourage you at any time to jump in and add color, ask questions as we go along. In the investment business, it doesn't always have to be stiff and stodgy. We can make this fun and interactive as well. So as Scott had mentioned, I've been at Brinker Capital for quite some time, 25 some odd years. We're located over here in Berwyn, Pennsylvania, northwest of Philadelphia, a little south of Valley Forge. Today we have a little over $30 billion in assets under management. In my role at the firm, I oversee our wealth advisory team. Wealth advisory team works with some of our larger portfolios and institutional accounts as well. And from those experiences, we get the opportunity to interact and talk quite a bit about portfolio investment processes, investment philosophies. And, from my interactions, quite frankly, with high net worth individuals and institutions across the country, we came up with this presentation today. And we like to think of it as what's on the minds of investors as we're rolling into the end of 2023 and into 2024. So we have three main items that we wanted to chat about today, and the fourth will be a little bit of a bonus item that we find coming up from time to time. At Brinker, we have what we refer to as a best of breed approach, where we try to identify investment strategies or investment strategists in various asset classes that we really believe are the best of breed. And we take that information, or think of it as a buy list, if you will, and we combine that with thoughts from our asset allocation committee. Our asset allocation committee, while we have long-term strategic targets, is trying to think about how do we want to allocate portfolios based on what we feel is the best risk return areas of the market over the next 12 months. So if we're able to do a nice job with the asset allocation, combine that with the due diligence process, and then quite frankly, combine that with the work that Scott and his team are doing from financial planning, risk budgeting, estate management perspective, well, we're going to get better outcomes for clients over time. And over the years, we have been successful in doing that. I know when I started back in 1995, we actually had about 300 million in assets, and today we're a little bit over 30 billion in AUM. So some anecdotal evidence to suggest that we're doing, something right out there in the marketplace. So without further ado, I'm going to go ahead and share my screen. Just bear with me one moment while I click on a few buttons here, and here we go. And here we go, page up. Okay, so as I mentioned earlier, we're going to talk about the top topics that are on the minds of investors. And our three main subjects today is we're going to talk about this bull market that we're in today. Have we really dodged a recession? And then we're going to round things out with election conversation. And time permitting, we'll get into a little bit about the current U.S. debt situation, which again is a topic that's always been out there, but it certainly appears to be creeping up again. So what to make of this new bull market that we're in today? Well, the first thing you might think is we're in a new bull market. Nobody told me. Well, what happens is when the market goes down 20% or more, that's considered to be a bear market. And we've certainly experienced that during fourth quarter of 21 and into 2022. And then when the market appreciates 20% or more after going down that 20%, you're then considered to be in a new bull market. Well, we've actually come up 25% from the market lows back in October of 2022. So we are technically in a new bull market right now, although admittedly at times it may not necessarily feel like that. Well, there's some good news, and we're going to go through some of these slides, these bullet points here on the slide right now, with some additional data that will highlight these topics. So with that in mind, let's go ahead and move on to the next page here. Investor sentiment. Well, the way to think of investor sentiment or investor feelings to the market is it tends to be a bit of a contrarian indicator. I often sort of joke around that it feels like the stock market is the only market in the world where buyers feel more comfortable buying when the prices are high and not low. So you sort of think about that. If there's a sale at the grocery store, a sale at the clothing store, we tend to go out and buy more of those goods or more of those services. But when there's a sale on the stock market, the exact opposite happens. We tend to get more fearful, and we tend to end up selling into a lower priced market. Well, we can actually track sentiment or track feelings to the market, and it serves as a good contrarian indicator. As a pretty good rule of thumb, when market sentiment gets low from a historical basis, you tend to have outsized returns for the next 12 months. So as you just sort of focus on the chart on the right-hand side, we see in hindsight in about October of 2022, market pessimism to the market was pretty low. And of course, since then, we've seen the markets, rise. And now that markets are a little bit higher, we're seeing sentiment rising as well and people becoming more enthusiastic about the market. So again, that's a good, trailing indicator. The other is that we want to look at is our valuations. So there's many different ways to value the market. Here we're just looking at a very simple price to earnings ratio. As investors, you probably know the lower the PE, the lower the price to earnings. In theory, you're able to buy more of a company's earnings. So therefore, it's a better value. Well, we saw that with the markets going down in 2022, the prices fell further than the earnings, and that's why the PE ratios came down from those lofty values that we saw in 2020, 2021, and actually, came down about 15, 16 times earnings. Since the bull market that we're currently in, we've seen this PE ratio come back up. Right now for 2024, Wall Street is expecting earnings somewhere around $247 a share. If we're just simply going to round that to about $250 a share of earnings on the S&P, that means we're trading a little under 18 times earnings right now, which in our mind is certainly a reasonable valuation compared to historic norms. So seldom does the market go up in a straight line, and sometimes that's the quirks. When you show different charts, you can make things look like a straight line, but it really wasn't. We have come up 25%, as I mentioned earlier, but you can see here there's been times along the way, particularly end of December, early January, the markets came back down, but directionally we are up 25%. So technically we are in the midst of a bull market. And here's the good news about that, is that bull markets tend to last for several years, not just 6, 9, 12 months. So this chart that you're looking at shows you since the early 1950s, the series of bull and bear markets that we've experienced. The lines going up in bluish color, that's your bull markets. The lines going down in red, well, that's your bear markets. And you'll see that on average, as noted on the top of the slide, that the stock market historically is up about 175 to 178% during those bull market periods. So again, we're up about 25-ish. We've actually come down a little bit. So that would suggest on average, we may have as much as 150% more to go. And this may continue for the next 3 to 4 years. The great news for investors is that the stock market does tend to go up more than it does go down. So while it may be tempting from time to time to try to, quote, time the market, which means I want to put all my dollars into cash and be a cash investor when I feel like the market's going down, or vice versa. I want to take all my assets and throw it into the equity market when I feel like the market's going up. Well, a better approach really is just simply to have a diversified portfolio, an asset allocation that matches, pardon me, your investment goals, your investment objectives, and then take a longer term approach. That's exactly what institutions do when they're managing their assets. And what we have found is that when individuals take that same approach, they tend to get better outcomes over time as well. So again, we appear to be in the early stages of a bull market. Well, we know that the Federal Reserve has been raising interest rates for approximately 18 months now. And the reason why they've been raising rates is that they want to slow down inflation. Inflation, as measured by either CPI, PPI, or PCE, all fancy ways to measure the increases that we or businesses are experiencing in prices or our expenditures, have absolutely gone up as we've come out of sheltering in place from the pandemic. Well, a little bit of inflation in the economy is actually a good thing. However, too much inflation is a negative. It tends to spiral. And if you have too much inflation, well, it just makes it harder for businesses to make earnings. It makes it harder for individuals to keep up, and their purchasing power, their spending power declines. Well, the Fed knows this. So they're fighting inflation with the one way that they know how, which is increasing interest rates. And when you increase interest rates, it tends to slow down the economy. You want to slow down the economy, that means there's less demand, supply and demand, that equates to what goods or services are priced at. So if we can slow down demand, well, maybe we can get inflation down. Well, the good news is that as we sit here in September, inflation has come down about 60 to 70% off of its peaks. And that's what these charts are showing you, these lines that are moving downward to the right. However, the inflation levels are still a bit too high. And that's why the Fed has been reluctant to stop raising rates at this point. As you may be aware, the Fed met last week and they forecasted the potential for having yet another rate increase later this year. But the Fed has certainly been reluctant in going the other way, declining interest rates at this point until they feel comfortable that inflation is under control. But again, the good news and the reason why that we're in this bull market now is that investors have seen inflation has started to come down, and investors are projecting that interest rates will likely be lower in 2024. As investors, the one thing that we always need to keep in mind is that the stock market really is trying to think about what's the economy, what are earnings going to be like 12 months from now. It's less focused about today and more focused about, let's call it tomorrow. And that is why economists often refer to the stock market as a leading economic indicator. So the market has been rallying in anticipation of a better economy in 2024 and lower interest rates. Better economy, lower interest rates, that means better earnings, better margins for companies, and therefore the stock market has been rallying here in 2023 for the most part in anticipation of better outcomes when we get into 2024. Now, this is a slide that I really like to examine. What we're looking at is the futures market for interest rates. So you might be aware there's a futures market for cattle, there's a future market for equities, but there's also a futures market for interest rates. And what we're looking at, August on the left-hand side of your screen, that's referring to August of 2023. Just wanted to clarify that. And what the futures market, when this slide was created, is telling us is that it feels that for the next, well, let's say between now and the second quarter of 2024, that interest rates that the Federal Reserve has set are not going to change. We're going to keep it at about 5.25. However, come the summertime of 2023, the futures market is expecting interest rates to decline. And again, we just talked about how the stock market likes to look into the future. And this is one of the items that the stock market is seeing, and again, rallying in anticipation. It'll be interesting to see how this futures markets may change in the months to come. Inevitably, it will change. It's pretty normal for a market. But right now, it's forecasting rate declines as we get further into 2024. And that would be good news for those of us that are equity investors. One of the other reasons why we're in the midst of this bull market has been what's been happening with earnings. Now, on the left-hand side, what we're showing you is what I refer to as the earnings game that companies play who are giving their earnings announcements to analysts. And typically, these are companies that reside in the S&P 500. So that's what we're examining on the left-hand side of this chart. Well, what we know is that it's pretty common for companies to beat the earnings that they're forecasting. And that's the game. If you're a CFO of a publicly traded company, you may think that your company is going to earn 11 cents one quarter. You might tell analysts that you're going to earn 10. And then when you earn the actual 11 that you're expecting, it's, quote, a surprise. And that generally is a good news scenario for your company's stock. Well, what we know is that on average, and this is what this chart shows you on the left-hand side, you could almost see it here, is that on average, companies beat their forecasted earnings about 75% of the time. So it's pretty common. And that's because the CFOs of these publicly traded companies kind of manage Wall Street expectations. Well, as you look at the chart on the left-hand side, the right portion of that chart, we look at 1Q 2023 and 2Q 2023, is that you see that companies are beating more than the average of 75%, approximately 78% in one case and closer to 80% in the second quarter of 2023. So earnings coming in stronger than expectations, not necessarily year over year, which is what the right-hand side is showing you, but earnings coming in better than expectations has helped facilitate this upward market that we've experienced thus far in 2023. So that is good news as well. Now, I just basically painted a pretty rosy scenario for the equity market, and I would be, it wouldn't be a fair presentation if I didn't spend some time discussing the many, many things that can go wrong. And there's always issues out there in the market, whether they're geopolitical or other, that could potentially cause the market to pause or to decline in value. And these are just some of the more recent business headlines of some of the, I'll call it the problems or the things that could go wrong potentially with the market. Certainly from a timing standpoint, historically, August, September, first couple of weeks of October, typically not good for the market. Sure enough, here we are in the third quarter, and the stock market has, traded off. We could have some international issues, whether that's China or Japan, potentially impacting the earnings in, here in the U.S. And, the one other headline there alludes to the housing market. Housing market's actually been surprisingly resilient so far this year, given where 30-year mortgages have risen to. However, certainly interest rates at these levels absolutely have the potential to slow down things like housing and other forms of construction, expansion, and that can certainly, slow us down as well. So I don't want to give the impression that this is a done deal, slam dunk. That's clearly not the case, but we are certainly cautiously optimistic as we think about the equity markets, marching into the end of 2023 and into 2024. Just one or two other slides here before we get into our next subject. This is just showing you that as a general rule of thumb, when the stock market has positive returns in the first six months, of the year, you tend to also have positive returns for the last 6 months, the remaining 6 months of the year as well. And there's nothing necessarily magical about a calendar, but rather this just sort of speaks to a market in motion is a good thing. Economy continues to expand, and current earnings continue to go up as well, and that generally relates to better returns. So that was subject number one that we wanted to dive into, this new bull market where, again, it may not necessarily feel like we are in a bull market, but that is technically the case as we sit here right now today. The other is recession. Are we going to be in a recession? Why are we not in a recession already? And we took the opportunity to throw out a couple of headlines in here. And in the popular press, what's been taking place here in 2023 has sometimes been referred to as waiting for the Godot recession. And for those of you who may be familiar with this, there is a play written by Sam Beckett, an Irish playwright, called Waiting for Godot. And the play has two central characters who are waiting for this individual named Godot to show up, who they're planning on meeting. And well, Godot never shows up. And that's the whole play is just around these two individuals waiting for Godot. They decide that Godot isn't going to show up. They still continue to wait for him. It's actually considered to be quite a good and interesting play. Well, the recession has felt that way. 12 to 16 months ago, if you polled Wall Street economists, 100% of them were predicting that we would have a recession in 2023, but it has not arrived, and we're going to talk about some of the reasons why that hasn't taken place. By the way, if you interview or those same economists today, 60% are saying today that we will not be in a recession either this year or into 2024. So the odds have improved, but certainly a bit split on what is the direction of the economy as we go forward. Well, there's many reasons why we have been fortunate in avoiding a recession, and we're going to dive into some of those here with some of these, charts and graphs. Part of it is, our budget deficit. We've been spending more, and that has caused us our surplus to decline as of late. But that has also helped us stay out of a recession. This is really our number one reason when we talk about labor and unemployment of why we're not in recession today. We've never had a recession in the U.S. when unemployment has been this low. So we've been extremely fortunate with that. You can see on the chart on the left, and by the way, when you see these gray bars, those are just signifying times of recession. So you see back when we were sheltering in place, the gray bar rises, and look what happens with unemployment. It goes up close to about 15%. But then as we began stopping sheltering in place, more individuals going back to work, you see unemployment, coming back down. And quite frankly, when unemployment's low, that makes consumers feel more positive. When consumers feel more positive, they're going to spend more. And as you're probably aware, the vast majority, close to 70% of our GDP comes from consumer spending. So a confident consumer is extremely important when we're thinking about the economy. The participation rate, well, basically what we do is when we try to measure unemployment, it measures everybody who is actively seeking a job, who's 18 years or older. So if you're not actively seeking, but you're not working, you're not included in the unemployment statistics. So we know that, coming out of the shelter in place, our participation rate dropped quite a bit. And you see that on the right-hand side. And when I say quite a bit, dropping 2-3% in the economy the size of ours is a really big deal. It equates to millions of individuals. Well, our participation rate is coming back up. That's great. But despite that, unemployment is staying low. So there's ample opportunities for employment for those individuals that want that. And that also has led to some healthy increases in wages over the last couple of years as well. So again, all reasons why we have not necessarily fallen into a recession so far. GDP, by one metric, GDP now is forecasting for us to have a pretty robust third quarter GDP number, as you can see here on the screen. By the way, as a point of context, that chart, when you see August on the right-hand side of the chart to your left, we're referring to August of 2023. I do want to spend a little bit more time on the home price side. With interest rates going up as much as they have, most economists were expecting home prices to materially decline. But as you can see from the chart, while they've come down a little bit, that's not really what I would call a material decline in prices. Now, the reason why we care about this as investors is that for the average citizen, for the average investor, their biggest asset is typically their home. So again, when home prices are high, you feel more confident, therefore you're more likely to spend, et cetera, and so forth. So home prices are absolutely very important as a fundamental underpinning to the health of our economy. So why has this happened? Well, if you think about your own development that you live in today, if anybody's putting up there, and pretty much as you think about this, not a lot of homes for sale in your development, certainly not as many as there were 18 or 24 months ago. And those houses that are coming up for sale are typically moving really, really quickly. So what we've seen is that the supply of existing home sales has pretty much fallen off a cliff, because as you know, if you want to sell your home today, you might have a 2.5%, 3.5%, 4.5% mortgage. You would close out that mortgage when you sell your home. If you go buy another residence, well, you need to go do that with a new 7.5% mortgage. So it makes it harder for you to move. So existing home sales supply has really come down. However, there is still demand for houses, for residencies. And as a result, home construction companies are actually still continuing to produce homes, trying to meet that demand. Now, they're being cautious. They're not buying all the land like they used to, 10, 20 years ago. So they're cautiously building. However, they're out there meeting that demand, which again, less supply. And that's the reason why we've seen prices kind of hanging in at the levels that they are at today. Modest drops, but not the significant drops that were really expected earlier in 2023 when we were learning about all these interest rate increases that have been taking place. So another reason why we've been pretty strong on the recession, or the lack of recession, thus far. Now, I mentioned there's still 40% of the economists think we might go into recession, and these are some of the reasons for that. So we are absolutely not out of the danger yet for an economic slowdown. And here's some of the reasons why. What this chart is showing you on the left is the difference between the 3-month Treasury bill and the 10-year Treasury bond. In a normal interest rate environment, short-term rates are lower than long-term rates. But today, we're not in that type of environment. Rather, short-term rates are higher than long-term rates. Well, the reason why we care about that is that if you're a bank, they like to take our money from our checking account, they leverage it up, and they loan it to somebody else at a higher rate. Well, it's harder to do that. And that's why when you look at your checking interest rates that we're getting, yes, it's positive, unlike 12 or 18 months ago when it was a 0%. But if we're getting that 0.5% or that 1% interest rate in our checking, it's because they can't afford, the banks can't afford to, quote, give us our full 5% that money markets might be doing today, because they're taking, again, those dollars and are lending them out to somebody else. So it distorts lending practices. So what banks do is they end up increasing their credit quality of who they're willing to lend to, and that slows down the number of loans that are being created. And when you can't get access to capital, it tends to slow down the economy, which is exactly what the Federal Reserve wants, but they don't want the economy to slow down too much that we dip into recession. Well, as a good rule of thumb, when short-term rates get above long-term rates and they stay there for an extended period of time, it tends to mean that we're going to have a recession. So this would be considered a leading indicator of a recession. On the chart on the left, you see 3 red circles, each of which precede the gray bar, which again is a recession taking place. So if you were to just look at this chart alone, you would not be without reason to predict that a recession is around the corner. Again, just looking at that one chart. The magnitude of these rate increases that we see on the left, just sharing this with you, that most recently we haven't had a rate hike, but the Fed has told us that we should stand ready for potentially increase in rates. But you can see that going back to 2022 to here we are in 23, boy, it's been a lot of interest rate increases. We started with 25. We had then several 75, and now we've been going back to 25. There is a bit of silver lining here, is that the smaller increases as of late means that the Fed, whether they increase one more time or not, are clearly closer to the end of the rate increases. And that's good news for us as equity investors. But here's the here's the tricky part that the Federal Reserve is dealing with. I mean, the Federal Reserve is a lot of really smart individuals, but they don't have precise tools, precise ways to simply push a button per se and say make inflation go lower. Rather, what they do is they increase interest rates in hopes of slowing down the economy, which after some time period should make inflation go down. And we're looking at a fairly famous quote from Dr. Friedman back in the early 1960s. He actually won a Nobel Prize in economics as a result of his work that he's done on monetary policy. And basically what he's trying to say here is that, hey, we know that when there's monetary policy actions or changes, which equates to the Federal Reserve increasing or decreasing interest rates, we know that the impact of those changes, well, are variable. Said differently, we don't know exactly what those changes are going to do. The other part of that is that we don't know exactly how long it's going to take for those changes in interest rates to filter its way through the economy. A lot of economists think it will take 4 to 5 quarters from when an interest rate increases or decreases for the economy to feel the effects of that. Well, remember the chart I just showed you. That means that for the next, let's call it 12 months, the economy is going to continue to feel the effects of the interest rate impacts that have already taken effect. So therefore, that concept of hey, we're home free, no recession. Well, we're not quite out of the woods yet because we just don't know exactly how the economy is going to end up reacting. One other item that could be a potential negative is the chart on the right. This is an index of leading economic indicators, and while whenever it's above 100, that's great, but it is beginning to roll over. As you can see, it's declining, so that doesn't necessarily foreshadow a lot of good news as it relates to the economy as we go forward. Optimism, particularly small businesses. Most individuals are employed by a small business, not by a big business. So small businesses are really, really key to employment and the U.S. economy. And just like individuals, you want to see optimism high. That means they're going to be hiring more and more into the future. Well, optimism, while off the bottom, is certainly low from a historic point of view. So that's something for us to watch as we move forward as investors as well. I'm just going to do one more slide here about the potential for recession in the U.S. economy, and that has to deal with the credit card balance situation. This is getting a lot of popular press these days. As you're probably aware, credit card balances have been on the rise. That means people are spending less of their dollars that they're getting from their paychecks or from savings and using their credit card for purchases. Well, that will work for some time period, but ultimately those credit card limits get topped out. You do have to pay that back. So in some ways, it's sort of like we're taking future spending and pulling it into the present at the cost of spending in the future. So while credit card balances are not outlandish relative to historic norms, we consider the growth of wages and the growth of GDP, they have absolutely risen in 2023, giving us a little bit of a pause for concern. And then in the lower left-hand corner, we have student loans. Well, student loans, you have not had to pay down your interest or principal for several years now as a result of us sheltering in place. Well, many individuals will now be required to start paying down their interest and or principal going forward. And that actually starts during the first couple of weeks of October. So we don't know what the effect necessarily is going to be from that spending that used to be going to maybe buy goods and services, and those dollars are now going to be used to pay down and service debt. So we don't know exactly what that income is going to be. So there are absolutely several items out there that can potentially negatively impact the economy and recession as we go forward. However, from where we sit, we do believe that the Fed is on its way thus far in creating what's referred to as a soft landing, where they're able to slow down the economy, bring down inflation, but not necessarily push us into a recession. So that is, again, good news for us as investors. I guess you could say I have 1.5 more topics to go. We're now going to turn our attention to the elections, and as I joke around a little bit here, as you may be aware, there's an election next year, and who's not aware of that? Feels like every 4 years the debates and discussion about elections keeps getting pulled more and more forward. And here we are still in 2023, and we've already had one debate. I believe another one is actually, I know another one's coming up. I believe it's actually tonight, if I'm not mistaken, on the Republican side. But as we think about the impact of the elections on the markets, well, we can look to more recent history. So on the left-hand side, we're looking at what's referred to as the presidential cycle. So this looks at the presidential cycle since 1961 to present. It looks at the 4 years and it says, hey, how did the stock market do in each one of the 4 years that the president was in place? And of interest to see there is that year 3 has historically been the best year for the markets. Well, we're in year 3 right now. And clearly a better return this year in 2023 than what we had in 2022. Well, the reason behind year 3 being a bit better is that whoever is the incumbent tries to the best of their ability to typically create more economic growth, more job opportunities, so that voters are happier, and then voters are more likely to vote for the current incumbent. Well, they start those activities a full 2 years in advance. And that's why historically year 3 tends to do pretty good. And you'll see here that in the same time period, going all the way back to 1929 to present, we've never had a recession in year 3 of the stock market cycle. So that's interesting for us to observe as well. Now, what I would tell you is from a stock market perspective is that typically the market doesn't really care who is in power. What the market does care about is that it doesn't like uncertainty. And when there's political uncertainty, well, that raises concerns for the market. Market doesn't know what the policies are going to be. Market doesn't know what the quote rules are going to be. So the market doesn't like that. So it's not unusual where the market likes it when the White House or Congress is divided. You have a combination of whoever's in whatever party's in the White House in control. You have different parties in the Senate or the House of Representatives. That's a good thing because that tends to create gridlock, which maybe as voters and citizens we might not like. But from a market perspective, when there's gridlock, that means there's less likelihood for changes, dramatic changes that would quote surprise the market. So we sometimes joke on this side, we have to practice the dark art of politics. And, this is what we're thinking about as we're investing and allocating assets. Not so much who is going to be in charge, but what will be the makeup of the president and Congress, and what are the potential policies that could result as a result of that, and that in turn, the policies could potentially then have an impact on the economy and the markets. So, Scott, I was going to hit one more subject, sort of a bonus subject, for lack of a better term, a little bit about our debt and the U.S. dollar. Our debt has been increasing as of late, and more recently in the news, Fitch downgraded the U.S. debt from AAA down to AA plus. Moody's actually downgraded U.S. debt approximately a decade plus ago. And so from time to time, we'll get questions about what's happening with U.S. debt and what level of concern that we should have. And certainly, you don't want to have a situation where you have so much debt, and more importantly, along with that debt comes the servicing of that debt, where it begins to pull away from what the government can spend on today to help out with other programs, right? If more and more of our tax dollars are going to service U.S. debt, well, that's a negative for the economy. It means less spending can be going towards other things, and that has the potential to slow down the USA economy. Well, you can see here as we sort of think about the debt situation as it relates to GDP, you really want to try to historically keep that number underneath 100%. And when we were most recently, shelter in place, we see that our debt relative to our GDP, where our GDP shrunk, the amount of spending that we did actually increased. That's a bad combination. And so our ratio is a bit out of whack. In 2020 and 2021, we see now that ratio is coming back a little bit. But nevertheless, it would seem to imply that we have a bit too much debt out there as a country. Well, the good news is that the U.S. dollar has appreciated despite the increase in debt, and that's what the chart on the left-hand side is showing you, is that since 2020, the blue line, when it goes up, it means the dollar is appreciating relative to other currencies, not going down in value. And on the right-hand side, we're just simply showing you returns of the stock market, as well as the international markets up 8%, and then emerging markets up 4%. So despite our increase in debt levels, relative to other nations' currency, the dollar has actually gone up in value, and our equity markets for this year have done better than that of the international, whether that's emerging or more developed. So part of the reason for this is that when you think about debt and the US dollar, it's a relative gain. And that's why we have this somewhat comical slide here on, or comical quote, pardon me, slide's not comical, but the quote might be, about being the, cleanest shirt in a drawer full of dirty shirts. If our debt ratios are not increasing as much as everybody else's, well, then the U.S. dollar, being the reserve currency of the world, it becomes less in jeopardy. And as U.S. citizens, we absolutely want the U.S. dollar to be the reserve currency of the world. So one way to kind of think about this, and I'll slow down just for a moment. If you look at the chart on the left, the blue is showing you the amount of dollars that are being issued in U.S. debt. The other colors that you see is basically debt issuance debt issuance of other nations. And while the blue line will go up and down a little bit, what you want to basically do is look at the line on the far left, where it says approximately 75% of all the debt outstanding was from the US. You fast forward to 2022, where that debt level actually comes down to, let's call it 65%. So relative to the rest of the world, our experience here in the US of issuing more debt is not unique. And actually, relative to the rest of the world, we're actually issuing less debt than the rest of the world. And that's good news, again, because it increases our ability to maintain our position as the reserve currency of the world. And Scott, just one last slide here before we kind of wrap up. Warren Buffett, I think, has just a really insightful comment here, which is don't bet against the United States. We have absolutely have had our share of problems over many years, but to have bet against the U.S. economy, and U.S. markets with perfect hindsight, certainly would have been a mistake. So Scott, thanks a lot for allowing me to present today. I know that we offered the opportunity for folks to ask questions, so I don't know if we have any questions out there in the chat room at this time or not, or if you or any of your associates might have some questions.
If anybody does have a question, there's no one in the chat right now, but you can raise your hand and we can allow you to ask your question if anybody has anything. Well, the one thing I wanted to thank Tom for presenting today, but Tom, one question: it's basically a lot of noise out there, right? You hear a lot of different things on news stations, social media, everywhere, right? How in the world do you filter everything out? I mean, it's just a tremendous thing, and it gives you a headache. So what do you focus on? How do you kind of filter through things and get down to what the actual issue is that is pertaining to investment dollars and how to then go about investing?
Yeah, well, I mean, Scott, you're spot on. I mean, there is a lot of noise out there. And let's face it, you can get that noise when you walk through the front door when you get home at night, right there on the TV, and now we even have it, right here on our cell phones as well. So there's absolutely good and bad to that. But really, as investors, I would encourage folks to really focus on the fundamentals, and don't get distracted by the short-term trends. So, the first and foremost fundamental is to make sure that your portfolio, your asset allocation matches your risk threshold. Because if that's not the case, boy, that's a recipe for problems down the road, if not at least initially. So, if you're a more conservative investor, then make sure you have a conservative portfolio. If you're a more aggressive investor, well, then stick with that aggressive allocation, because presumably you have a longer time horizon that will allow you to ride through the bumps that will inevitably happen along the way. So, Scott, I would say number one is certainly make sure that your allocation matches your risk threshold. And then issue number two, or suggestion number two, is to make sure that you do have a diversified portfolio. Boy, it's really hard to predict the short-term directions of the markets. So one item that will help you ride through short-term downfalls in the market, which inevitably will happen, is having a diversified portfolio. And we say diversified, not simply investing here in the US, but also have some international exposure, have some fixed income. And we also like the diversifying assets where appropriate of global credit, which is fixed income that has a little bit more what I would call risk to them, but you get paid a little bit more for owning global credit securities. We have another asset class that we call absolute return that is just a really good diversifier. It tends not to act like your bonds. It tends not to act like your equities. So as you're building out that global portfolio, it can really help create that steady level of return. And then six would be potentially including some real assets. These are investments that tend to do a little bit better during inflationary time periods. So this would be exposure to energy stocks or commodities. Appropriate, again, when you're thinking about that total asset allocation. So, Scott, I would say those are the two main items: portfolio that makes sense from your risk threshold, and then a diversified portfolio as well. You do a combination of those, more often than not, you're at least going down the right path.
That sounds good. That sounds good, and that's why we're here to be financial advisors and teaming up with Brinker Capital to reduce that noise and exposure to your portfolios and accomplish what you want to accomplish. There was one question. This is being recorded, so this will be on the website here in about a week, maybe just longer. But you'll have access to the whole discussion, the slides and everything through our website, and we'll be able to send that out to everyone. Any other questions, or you put through the chat, or raise your hand? If not, Tom, thank you very much for your time and expertise. We appreciate Brinker Capital's partnership and continued success with our clients' goals and everything. So with that, it's 11:52. We'll end a couple minutes early, but I appreciate everybody else's time on attending the call. And if you have any questions that you think of after the fact, feel free to reach out to myself or any of our teammates, and we'll get those answers and your questions answered for you. All right. Well, everyone have a great day, and we'll talk to you soon. Take care, Tom.
Thank you. Take care, everybody.